Do
Get
you
this.
want to
Stand by.
make me a co-host so I can share my screen?
Yeah, just some. Hey, good morning, guys. This is Ken at Tortoise Capital, and our guest and buddy, and not even a guest, really, just one of the guys that shows up. One of our team players, Bill Scheidt, is here. So this is the first live Q&A session for the Research 2023. So I want to take a few minutes to put it into context. My experience with the THARP Institute began in mid 90s as a student, then as a guest lecturer, then as an instructor, and then as a workshop runner. And as I went through that process, started adding more and more material, and my fear was always that I would be under teaching, so I always ended up jamming as much information into every workshop as I could in order to give people as much as I knew. One of the challenges of that was that the fire hose effect that Bill talks about in his video lesson here. And I was always discouraged when, 3 months after the workshop, I might get an email from somebody and they were saying, hey, I don't even know how to get started with this, or I'm not using it because there was too much. And I didn't have a plan to put it into action. And so we tried some workshops where I had a very narrow focus on the skills and practice it. And that turned out to be a better, but it also generated more questions about other material that we didn't cover. Like, hey, you were using these assumptions in these modules, but you didn't cover that in detail in the workshop. How does that work? So it's just a fact that traders tend to be, lone rangers in many ways. And they want to know all the way down to the lowest particle how systems work. At the same time, they want to be broadly exposed to material. So there's just a limit to how much you can do in one session or one weekend or whatever. So started to experiment with online courses, and I also began to do research weekends and live trading weeks, starting back in, I think, 2009 was the first one that we did. And Bill and Jeff and Sonal and some of the other folks that will be presenting this month started with me back then and kept coming back year after year. And what we did was we had them come in and present research on how they specifically were applying the material that we had all collectively worked on in the form of a graduate student presenting a thesis, or an academic conference presenting some research, followed by Q&A sessions. And we found that, and then we followed that up with a week of live trading where, since we were all here in Kansas, why not stay longer and then trade during the week, Monday through Friday, on our own ideas, but also sharing our results and getting practice with each other's systems and work as a collaborative team. And that was hugely fun. And one of the things that we learned was that's a lot of time to spend together just trading. And so Bill was kind enough to bring his traveling roadshow with the drums to there, and that turned out to be the real reason people came, was for the drumming, and we had just a great time with all that for many years with the drum sessions. It turned out to be an amazing way to generate the zero state, to understand trading holistically down into our hands. We were learning to trust our hands at whatever level of knowledge we were at, which I thought was a profoundly important psychological insight. And it felt really good and really helped me with my own self-confidence and the desire to keep putting things into action. COVID hit. Travel was not possible. We shifted to mostly online or all online work, and then spreading that over time. And we were doing nightly podcasts, and we're generating a lot of insights, but it's like getting on the merry-go-round, thing that starts spinning at its own rate, and it's sometimes hard to get on. So we wanted to resurrect the idea of the research weekend as a way to let the traders come back in and show what they're doing, kind of a show and tell, and to just appreciate how many different ways there are to apply these basic concepts that we're studying together, and how when you adjust it to fit, it takes on your characteristics, your personality, and suits you. It still may be of interest to other people because we do share, some backgrounds, and some systems may fit better than other systems. So this was a chance really to do a theater in the round, some participatory presentations. It acts almost as a coaching session between me and the presenter where we're co-creating and co-teaching. It's also a really important source of new ideas for me because it helps me see where people are. I get to listen to the questions that you have so I can see what it is that we might need to add to our courses or to add to the discussion. Because a really good question from a good student is what empowers the teacher to shape the next excursions. And so I'm really grateful to all the guys who are participating in this effort. This is really the first time we've decided to try it this way. And the first couple times we did it online, what we did was tried to get a time when everybody could come together for 3 days and go from 8 o'clock in the morning until 7 o'clock at night with one briefing after the other and rapid fire questions and answers. But it's really hard to get people around the world together for that kind of thing. So I'm trying it this year where we're having the guys make their presentations first, give you, the students, a chance to listen and to prepare and send in some questions or take questions live from the field, and then do that over the course of December in order to let people pick and choose, but also to be focused when they're here, but then also recording it so that even if you're not there for a session, you can come back and listen to it on your time. So all these are being recorded, and we'll get them added to each of their individual lessons. And then by putting that in the Rizuku framework, the online course framework, we're able to support that kind of continuous online discussion. And then the office hours that I'm doing with Foundations and Creativity are a place where you can continue to ask questions of me. If you're too shy to reach out to Bill or whatever. And any questions that I can't answer, I'll get to Bill. So we're going to give this one a try and see how that goes. And the idea is that we continue to grow our body of knowledge around the concepts and systems that we're using, but also spread the learning out in a repetition and reinforcement style where we can keep coming back to the material. It's very much like the makers workshops that you see in the big cities these days, where there's tool rooms and material and master craftsmen are kind of in there, and folks come in and learn how to weld or do woodwork or metalwork or glass blowing or whatever it is, and they do that in a community and collaborative way. So that's the spirit that I hope to inspire with what we're doing. It's the way the Tortoise Community of Practice and the OWL Group Community of Practice has always worked, and it's very satisfying to people who like to learn in that way, where you're not under pressure, you are free to explore your own space, you have just as much help as you need, and you have multiple people to share with to form your own natural work groups and whatever. So I'm just really grateful that folks are giving this a try, and I appreciate the Foundations guys who are here today. We're using their office hours time. It was my opinion that Bill's material is especially well suited for you at where you are in the courseware, because here's a guy who's been where you were or where you are, that's where he was 15 years ago, and it's been a real pleasure to watch him put these things into practice with his own responsibility for results and his own bright spirit and his wonderful family, and to know that we're doing good in the world like this is really the greatest reward of all. And so I'm really pleased to be able to introduce to you guys Bill Scheidt. And please feel free to use the chat for loading up questions. We're going to operate on the assumption that and with the intention was that you guys had a chance to review and study all his material ahead of time, and we can go right into questions. But it seems natural to me to have Bill do an executive summary of his slides, hit it kind of quickly. It won't hurt us to hear it a second time, but if this is the first time you're hearing it, then it will make the questions and answers a little more sensible. I have a page worth of questions and discussion points to fill the hour, so don't worry about that. But we got Bill for about another 50 minutes or so. So we're going to have Bill present his material in chunks, open it up for questions. I'll try to act as a moderator, and then we'll finish up. Later today, Jeff Southern will be briefing us too. He's got some amazing material coming out of the Creativity 202 course to share with us. So without further ado, Bill, I'm going to go ahead and launch it over to you, and just thank you for making the time. I know you got soccer with Finn later today, and I appreciate you sharing your time and ideas with us. So, ladies and gentlemen, Bill Scheidt.
Thanks, Ken. I appreciate you for having me. It's really an honor and a pleasure to be here. You know, I consider myself an eternal student, and so to have the opportunity to be here and share with the rest of the students is a fantastic connection. So in this presentation, we are going to look at the top 3 Ken Long concepts that I feel I've learned from Ken over these last 15 years. And I like to joke around, you don't have to study with Ken for long to get the feeling that studying with Ken is like drinking from a high pressure fire hose, because the guy is just a continual stream of genius level trading concepts. So kind of as a way to focus in on the incredible value of his teachings, in this presentation, I've narrowed it down to the top 3 concepts I've learned from Ken. And for each of these, we're going to take a look at what is the concept, how do we apply it, and what kind of trading results we can get with these concepts. So before we jump into our first one, I'll just say, please be disclaimed in all the ways here, including but not limited to the fact that I am not a licensed financial professional or advisor. Nothing I'm going to say to you is is advice. It's all research. This is all educational content, and it's not a solicitation to buy or sell any investment, any vehicle, et cetera, et cetera. With that said, our first concept that we're going to look at is the PSAR on the RL10. And as I said earlier, we're going to answer these 3 questions. What is it? How do we apply it? And what are the results? So what is the PSAR on the RL10? The PSAR, of course, as you know, is the parabolic stop and reverse indicator. It was first developed by J. Wells Wilder Jr. You may know him because he's also the father of the ATR and the RSI. The PSAR is like the out-of-the-box version, is an excellent indicator, but like all things, it does have strengths and weaknesses. And one of the weaknesses is that when it's applied to price, it can be a little bit whippy. So the solution to this, which I think is just an absolutely ingenious innovation pioneered by Ken Long, is to apply the PSAR to the RL10 instead of to price itself. And as you know, the RL10 is the 10-period regression line curve, which essentially represents the mathematical best fit line for a set of data. So it's a smoothed version of price. And it turns out that applying the PSAR to the RL10 means that there's less noise than applying it directly to price. So that means that the PSAR flips less frequently in choppy markets, which is a brilliant solution to the one weakness of the PSAR as originally created by Wells Wilder. So how do we apply the PSAR on the RL10. One system that I trade that prominently features PSAR on the RL10 is the PRX crypto system. And this one indicator plays a number of very important roles in the PRX crypto system. So first of all, it functions as a tactical trend indicator. It functions as a tactical trend reversal indicator. It functions as a place to set initial stops and as a place to set trailing stops. The PSAR continually reduces risk in the trade over time because it moves regardless of whether price moves. And that's a function of the acceleration factor in the math behind the PSAR, and it translates into cutting losses quickly. So if price just moves sideways, the PSAR moves up on its own and eventually gets us out. As a trailing stop, not only does it continually reduce risk over time, but it also gives price plenty of room to run, which means we can generate large R multiple wins and leverage the belief that the trend is your friend. One of the things that I love the most about the PSAR on the RL10 is that it adapts to volatility. And again, that's down to the inherent function of the math involved with plotting the PSAR on the RL10 instead of price. And basically, it means that as volatility increases, our initial stop will be further from price. So that gives us appropriate space without getting stopped out. And it also gives us manageable position size in rough seas. I've heard traders complain in the past about not being able to trade markets because they're too volatile. I do agree that using methodologies that are not volatility adaptive in highly volatile markets is definitely a formula for disaster. However, in my view, being able to adapt to volatility is a make or break element of trading any market. And so the PSAR on the RL10 is just absolutely brilliant, in my opinion, because it allows us to accomplish all of these functions that we're looking at here in just one simple indicator. So for me, it's just absolutely brilliant. Applying the PSAR to the RL10, just amazing. So what kind of results can we generate from this? As a way of highlighting just how versatile the PSAR on the RL10 is, we're going to look at results on 3 different time frames. For swing, we are going to look at the PRX crypto ETF swing system. For intraday, we're going to look at the PRX intraday system, one version that trades on 30-minute bars. There's more than one, but we're going to focus on the 30s. And for longer term, we're going to look at the PRX weekly system. So these are the backtest results as generated by the PRX strategy on TradingView. For the PRX crypto ETF swing system, we have an SQN 100 of 3.87, which by Dr. Van Tharp's definition makes it an excellent system. We have an expectancy of 1.78. Yes, the decimal point is in fact in the correct place, not 0.178, but 1.78, which is very high for a swing system. The reliability is 58%, and the win-loss ratio is 5.6 to 1. For the PRX intraday system on 30-minute bars, the SQN is 5.53, which by Van Tharp's definition makes it a superb system, and he says few of these exist. The expectancy is 0.24, reliability 37%, and a win-loss ratio of 2.86 to 1. For the PRX weekly system, the SQN 100 is 6.37, which by Van Tharp's definition also makes it a superb system. The expectancy here is 2.26, reliability of 73%, and a win-loss ratio of 4.45 to 1. So that brings us to the end of our first concept here.
Yeah. Let me. I was going to jump in here. So
yes,
there's a couple things that, as a coach or a reviewer, if I'm watching the tape, when I look at these important summaries that I look at. So I want to talk about all 3 of them here. So in the first one, the crypto ETF swing. So it's 6 years of data, actually 7 years of data, 45 trades, 60% win rate, and a payoff ratio of about 6 to 1. So the first thing that I do when I look at these tables is I convert it to the coin flip game to personalize it, because I think of it as a Las Vegas simulation. So this is one that I win 3 out of 5 times. So 3 out of 5 times I win, 2 out of 5 times I lose. And when I win, I make 6 to 1. So that's obviously a system that I want to play forever, and it's a system that I want to play it as many times as I can. So the first question I would ask then is the troublesome part of this one is that it only has 6 trades a year. So my question is, what symbol was this trading on in the test?
So this is a combination of two symbols,
Okay.
GBTC
Okay.
and ETHE.
Okay, so it's the two biggest cryptos, so you're not getting whipped around as much by, short-term trader volatility, but you're getting the two biggest players in the space. So then the next thing that I say, well, is now I want to, my next rounds of research are going to be, how do I start adding more targets so that I can get more opportunities? Because this is one where I have all the expectancy that I could hope for, but now what I got to do is increase the opportunity. And then as I start adding more and more symbols, while keeping the same criteria, what does that do to the performances? So don't answer those yet unless you've done them. Then the second thing I look at is, if I can't go in that direction, then what I do is I start looking at relaxing the criteria in order to get earlier entries or to get more entries, to see what that does to degrade the system quality number. The third thing that I look at then is increasing the time interval, so that instead of swing systems, does it now convert to hourly bars, to 30-minute bars, to 10-minute bars, trying to use the same fractal structure, and then just get more cycle time. So those are the things that I look for there. When I look at the intraday system, just as a comparison, I get the other problem at the other end of the spectrum. Now what I have is a 37% win rate. So if I'm going to scale that down to 33% and say, look, this is a one win for 2 losses. Now it's a coin flip where I only win 1 time out of 3, but my payoff rate is 3-1. But now, more importantly, I'm getting 5 or 6 opportunities. No, I'm sorry, not this. I'm getting 1 opportunity a day for 2,100 days. So this is a case where I have sacrificed the amazing coin flip. I still have positive expectancy, but now I've added opportunity. So these two, to me, really show an important spectrum of this trading idea of the PRX, the PSAR flip around the PRX, because on one end I can really tighten it up and get fewer trades but get amazing expectancy, or I can go for maximum opportunities and still get a really favorable payoff. I mean, collecting 500 R over the same time period as compared to 80 R, you're talking about 7-1 R capture. And so that's one of the reasons why you would accept a lower win rate. So I think those two side by side really demonstrate the trade space, the designer space that we're going to use to find something that fits. Now, it doesn't mean you have to do one or the other. You could do both of these. You could find a midpoint. You could find some blend. But this really shows what can happen at either end of the trade-off space, and why research matters so much is because there's a lot of room to examine other opportunities around these basic, simple rule sets. So that's what I wanted to say there. I want to shift over to Joe for you. He in the chat window. He's asked this question. In addition to stops and reversals, are you using the PSAR for your entries? And I'll let you discuss that, and then I have an answer for that myself. Go ahead.
Yeah, sure. Joe, to answer your question, yes, the PSAR does play a very important role in our entries. So yes, it also is entries. So that's just, and it's a great question, because really what you're pointing to is just one more indicator, if you will, to use the term in this context, one more indication of how powerful applying the PSAR to the RL10 is. So not only does it cover all the things on the last slide, but yes, also entries as well. And Ken, I completely agree with your analysis of the spectrum between essentially quality versus expectunity. And like you said, you don't have to choose one, you can choose both. One of the things we found in our research is that the PRX system is incredibly robust, generates excellent results on daily, on 30 minutes, on 10 minutes, on 5 minutes, on 3 minutes, even down to 2 minutes. So there's a lot of opportunity to find versions, configurations of the system that fit you as a trader. Not everyone wants a trade swing. Not everyone wants 3 minutes, 30 minutes, 5 minutes. So you can pick instruments as well as timeframes that are going to fit you, and you're going to get very good results with that.
Hey, so let me ask you about the third column, the third chunk there, the PRX weekly. Yes. How is that different from the first one, which is an ETF swing system? The ETF swing in the sense that the two cryptos targets that you're using are actually ETFs on the crypto. So you're actually trading an ETF, which is then connected to the price action of the crypto. So you're not trading cryptos directly. You're using symbols that are very large and liquid and are a little bit smoother than the crypto itself. But yeah, could compare and contrast the first and the third system for a moment, if you would.
Yeah, sure. So the PRX weekly system, these stats that we're looking at here are on BTC USD. So Bitcoin directly as traded on any crypto exchange versus, like you said, the ETFs.
Yep.
And I think one important element there to point to is that there are a lot of different vehicles, trading instruments available in the world of crypto. Not everybody feels comfortable trading crypto on an exchange, perhaps because of the exchange risk, or just they don't want to set up another account at a crypto exchange. So these systems operate brilliantly on ETFs. They operate great on spot prices. They work on crypto futures. So they're very robust. But there is a difference here because the weekly system is actually BTC USD versus GBTC. However, just last month, it's funny you brought this up, one of the students in our community asked, well, hey, how well does the PRX weekly system work on GBTC instead of BTC USD? And it turns out that it works brilliantly. So the results that we're looking at here are on BTC USD, but if we looked at GBTC, it would also look excellent.
Yeah, so Mark sent me a question. Are we talking about the relaxed PSAR input of 0.14 or 0.12? I believe it's 0.12 because that's what we have been using for the longest while. 0.14 is a recent phenomenon of 2023, but if you could confirm that or not.
I think so. I would have to hop over to a different slide deck just to confirm, but I'll make a note to send you an answer to that offline.
Yeah, so my sense is that it's the 0.12 because these are derived. This slide deck is derived, and the results are derived from the course that you and Jeff put together to teach at VTI. Last year and this year, and so the 0.14 was something I'd been toying with this year. That gets to the larger point that one of the features of using the RL10 as the price input is that you get a pretty smooth set of dots, and you can tune that pretty easily with your acceleration factor. Once you get the distance away from the flip, how far when it flips does it actually flip, then you can tune the PSAR dots pretty easily, and you don't get dramatic changes when you're using the RL10 instead of price. There are times if you start trying to tune the PSAR and you have price as your raw input, there will come a time when you see the PSAR lines moving closer, and then all of a sudden it'll go berserk. It'll be nonlinear, and you get a completely broken set of PSAR. And that's always because the length of the individual wicks has now started to distort the line. Because the RL10 is so smooth by its nature, you're now able to fine-tune that very carefully. If you could go back one slide, I just want to point out that phenomenon. If you look at the extreme right-hand side of the slide there, go back to the 6th bar, the big red one. Now see, that's the second most extreme bar in the whole deck. But it doesn't shift the PSAR flow, and its overall net effect on the RL10 was kind of insignificant. What that tells you is that volatility was not transformational. It didn't change people's mind. In fact, that thing started and ended at the same point, almost exactly on where the blue line crosses it. The way that blue line is created is that it looks at that bar in the previous 10, and then it places the blue dot on the bar where the perfect price would be predicted, where it should be based on the integration of the last 10 prices. So you get a very continuous signal. It's almost like, and this just occurred to me, and this is the beauty of this workshop, if you drew the box around the PSAR flip, as we talk about the PSAR box all the time, think of that as a flower pot, and then out of that you have that little blue vine, like a little grapevine, and then the individual bars are like the leaves on the vine gathering the sunlight and reflecting, the activity of the weather. And it's in the growing season, so you don't mind the volatility. But when you get the extraordinary break like you did where if you go right to the middle of the chart, the single largest red bar, left, yep. Now that one turns out to be a reflection of a real change of mind in the underlying traders. They went from a upward growth mentality to a harvesting mentality in a single bar. And not surprisingly, the RL10 shifted right at that point. Now back to Joe's point about using it for stops and reversals, here's what I want to say. And this is also connected to my own research. There's actually times when I'm entering before the PSAR actually flips, meaning that it's coming into the station and it's not failing any further, but it hasn't reversed enough to flip the PSAR, and that may actually be a wide enough box that I can get a 1, 2, 3 entry or a WMB3 entry, and I can start positioning towards the next move, even before the PSAR officially flips. So I think of that as before. I think of it as during, if I'm using the PSAR dot as the actual entry point. Now you can make a decision on whether you're waiting for price to hit it or the RL10 to hit it. That's a difference of 1 or 2 bars at times. But I can enter on the beat. So before, during, or I may end up using an owl strategy where I'm waiting to enter until after the PSAR flip has occurred. And the owl entry is typically anywhere from 2 to as many as 5 bars later by the time the RL30 has reversed and the dragon has reversed. So what this does for us is it gives us the PSAR trend line, but also the size of the flip box as standard templates around which we can make a refined decision. So the specific answer is that depending on the time frame and the time of day and whatever else is going on, I can make a decision to enter before, during, or after the PSAR flip itself. Like I might use a 1, 2, 3 exit, and I might actually get out before the PSAR is hit because I've got an abnormal win and I want to lock it in, and that was enough. And indications are that the PSAR may flip in the future. So I might front run the exit decision based on other considerations. What I like about the way you've got this thing set up and structured is that I can see very clearly a useful trade-off between how tight the flip is and how long the trends are. Like for future research, I'm looking at a PSAR dot counter, and an indicator that will help me start finding the statistics on the length of the PSAR trend. Like if I took this one system and started counting it, I would want to go back to the last 200 trades and find out what is the average, what is the minimum, what's the maximum, what's the standard deviation, so I can start getting expectations about normal moves when I use that particular set. Then that allows you to decide with some evidence, is this thing in the early stages or the middle stages or the late stages of what is a typical move? So it's not a prediction, but it's knowing where you are in the song, knowing where you are in the typical growing season, and then that allows us to develop unique touch with respect to the instruments that we're trading, and that gives us a very serious edge. So the point I want to make on this one, Joe had asked me a question offline. We're not briefing strictly one system that's been optimized. What we're trying to show here is that research allows us to establish a protocol, a regime for multiple studies. And so this is also another one where a good research protocol will suggest future research. So on this one, it's figuring out, do we have the acceleration factor right? Are there other RLs that could be more useful? Is it fractal? But also, to me, a high payoff one is the PSAR dot counter, and what I'm going to end up calling, I think, the trend stat, which is going to simply tell us what is the average length of trend so that I have an expectation, so I can start adjusting it according to the growing season. Now, we have seasonality like the MACD, but I also want to tune it to the specific length of trend, and that's going to help us. So that looks like all the questions we have on this one, and we're about 25 minutes in. So let's go ahead with your, unless you have some other comments on this one. Let's go ahead.
No other comments.
Let's drive on.
The only other thing I would add here is that for the PRX system, we did not optimize any of the inputs on the RL10 or the PSAR. So it's straight out of the box as you teach it to everyone.
Yeah.
Just to clarify.
And that's what's amazing, because if as you know, the thing that I beat you up on all the time is how relaxed you are on your exits. For example, if we go back to that great big red bar, you've been waiting for that price to come all the way down and hit the PSAR, actually waiting for the PSAR to flip, if I recall, to make, and to me, you want to preserve more of that leg up that resulted in the peak. Because what I look at is how abnormal was the length of that move up, and I want to start harvesting sooner than the PSAR. Like, I don't want a parabolic move which is going to be the farthest away from the PSAR dot. I don't want to experience a positive parabolic only to watch it come all the way back to the PSAR. Now, the PSAR accelerates, I get that, but it is also limited by how much it accelerates. And we've capped it at a certain rate so that we get the nice, long, smooth. A natural place to add an extra rule to this is what to do with abnormal gains when you get that kind of parabolic move and it starts to roll over. And so I like to sell on the far side of the RL10 after it's crusted. And if it was a good enough move, I want to preserve more of that move. So that's typically the place where we look at adding a contingency move or a contingency exit rule to improve and fine-tune a rule set. And it's geared to a really good problem, as how do I solve the problem of having a really great result in my normal exit is a little unsatisfying. So that's a very good problem to have. That's also a common feature of those crypto systems, because you get so many young kids in there slinging money at it for the first time that you can get really asymptotic moves that are not sustainable. So you want to be able to preserve some of that, and that's where that extra contingency rule can really pay off. So more to follow on that in the future. All right, Bill, go ahead, drive on to momentum, please.
Yes, sir. All right, so concept number 2, momentum. Again, we're going to take a look at what is it, how do we apply it, and what are the results. So what is momentum? Well, to oversimplify, momentum is the capacity for a price trend to continue. I like to think about the relationship between the concept of momentum in the world of physics and in the world of finance. So in physics, momentum is a quality possessed by an object in motion, and it's a product of the size and speed of the object. This, of course, connects to Newton's first law of motion. Objects in motion tend to stay in motion. In finance, momentum is a quality possessed by a market in motion and is a function of the size and speed of the trend. So the idea here is that markets in motion tend to stay in motion. This also connects to the market belief that the trend is your friend. So momentum is a concept that allows investors and traders to profit from the herding behavior of market psychology. And momentum has been tested in the scholarly market literature and is an academically rigorous concept. You can see the research done by any of the authors here, including Ken Long himself and numerous traders in the tortoise community. So how do we apply momentum? Our BMR and monthly momentum-based asset allocation systems are powered by the concept of momentum. And in these systems, momentum helps us in a number of ways. So we use momentum to identify and quantify trends across the world's major markets. Momentum gives us the ability to allocate portfolio assets to the world's best performing markets, which leverages the herding behavior of market psychology and lets us profit from trend continuation. So what kind of results can we generate with the concept of momentum? We're looking at backtest data for 2 momentum-based multi-asset allocation systems. On the right in green, the first column labeled momentum is a standard out-of-the-box system, is very similar to the first generation BMR systems taught by Ken for the last decade plus. The second column in green is a second generation system that adds optional volatility stops and short positions that I've developed over the decade plus of trading these. On the left in tan, first column is buy and hold for S&P, and the second column is buy and hold for a globally diversified portfolio that's 60% stocks and 40% bonds. For the first 5 metrics, that's total return through ending balance, we see that the standard first generation configuration beats the S&P on all 5 metrics. And then when we add the volatility stop, the numbers get even better. And then I'll just point out too, here we have an excellent SQN. We have very good expectancy, and our return to drawdown ratios are just absolutely phenomenal when we compare them to S&P and 60/40. And that has to do with the fact that we have very high returns, and we're doing that on a fraction of the drawdown of S&P. So with that, we can hop into question and answer.
Yeah, Joe's question here was, what indicators specifically were you using to measure momentum in this setup?
Yeah, so Joe, we actually don't use an indicator per se. It's these momentum systems, the monthly based systems, are completely charting free. So it's all based on price over 2 different look back periods. The acronym BMR that Ken created, blended monthly rebalancing, the blended part is us looking at momentum over 2 different look back periods, blending that together, and then allocating our assets based on the momentum of various potential holdings in a universe or a potential portfolio of instruments that we could invest in.
Yeah, so specifically, it's the 70-30 blend of the 3-month and the 6-month. So when we looked at every monthly combination between 1 month and 24 months of momentum, and we build a composite relative strength indicator. So relative strength, the way we're constructing it, is a function of the blend of 70% of the 3-month performance and 30% of the 6-month performance, applying to all of the candidates in a portfolio, and then ranking them by the blended performance, and then selecting the top X number of those, and then looking at it to see if it's above the 4-month moving average to determine if it's worth, if it is stable enough to buy it. So if it meets those criteria, you hold it for a month. The details of that are in the downloadable BMR study that's in the Foundations course. And so we're using that that our version of relative strength to capture the idea of momentum. Now, neither in the first column there, he's not using shorts at all, and in the basic version of the blended monthly rebalancing, we're not going short at all. But what we're doing is moving to cash positions when the market conditions are not optimal for going long. Now, what that leads you to is understanding the difference between momentum on the long side and momentum on the short side. And that means that it's walking up the steps and jumping out the window, that the momentum and volatility is not symmetrical. On the way up, you get grinding moves where money is in the winners, and then it rotates among shifting leadership, but still going up. So you end up getting a smoother, grinding, longer-term move, and then periodic, painful, sharp, bearish moves that erase massive quantities of gains in short periods of time. So rules that work on the upside don't necessarily work on the downside. So if you then try to get a blend, what you end up is sub-optimizing, unoptimizing rules that work in both directions marginally. So you, in an effort to try to get symmetrical rules, you end up actually hurting your performance. When it comes to momentum, you need to appreciate the difference in volatility and momentum in bullish markets versus bearish markets. Now, the problem with sideways markets is that it has characteristics of both. And that's why we use the moving average filter to determine if it is directional enough to be able to, and stable enough to use the more conservative growth rules. So I do want to say that. Now, the advantage of the long-term momentum-based systems is that when you do get indications that it's not the growing season, you actually have a signal to fire up your shorter-term volatility-based systems and use them while the season favors volatility. So this is an example of systems that are tradable on their own merits, but also provide information content about the state of the market. And that's one of the reasons that I look at those every day and every week. Even though they are monthly adjustment systems, they also provide ongoing information about the current state of the market, which I can exploit with other trading systems. Mark asked the question here, well, to finish Alex's point, yeah, inverse ETFs and options are absolutely well-suited to exploit those contingency plays. You see that a lot in the options course that Danny Ben Yair did for us, and you'll see it in Matthew Richardson's systems, where he uses his longer-term systems to help him pick and choose moments of playing options. Mark says, it's unusual to see the maximum drawdown decrease as the annual return increases. Exactly right. And that actually is giving you evidence that undermines the common traditional belief that in order to get larger payoffs, you have to tolerate larger drawdowns. Our experience is that's not true in every case, that there are times when you can protect against volatility, shift to cash, and increase your performance so you get better growth and reduce volatility. You don't actually have to accept both of those. So it's always good to question assumptions and to take a look at the data that supports those assumptions. Under what conditions is that assumption no longer true? Just remember that rules of thumb are designed to work most of the time, but not all of the time. And otherwise it would be science and a rule. Assumptions are good enough for most of the time, but at the boundary is where you find the real difference. That's where you start looking for exploitable edges. So always, always, always ask what are the assumptions and the parameters of the research that supported that conclusion. And this is a perfect example of that. So good question and good insight. All right, Bill, let's go ahead and drive on to your the final portion here with moving averages.
Sounds good. Yep. So moving averages, this is the third concept here. So what are moving averages? In their most simple form, they're a mathematical mean of a set of price data over a specific number of bars. There's a number of benefits of using moving averages. They smooth price data by creating a continuously updated average price. They can be used to identify trend. We can use them to classify market type. And we can also use them to determine support and resistance levels. Of course, moving averages are a very common indicator used in technical analysis, with the 50 and the 200 being very popular and generally considered to be important trading signals. The concept of moving averages has also been tested in the scholarly market literature and is an academically rigorous concept. There's a number of authors out there who have researched this, and of course, as you all know, Ken Long has used moving averages in his work for decades. So how do we apply moving averages? We have monthly asset allocation systems. We call them portfolio moving average systems, and they are driven solely by the concept of momentum. They're very simple systems that generate very powerful results. And in these systems, moving averages help us in a number of ways. So we use moving averages to assess market conditions across the world's major markets. We allocate assets to the global markets with the most favorable conditions. We use moving averages to avoid major bear markets while also capturing long-term trends and avoiding market noise. So what kind of results can we generate with the concept of moving averages? We're looking at backtest data for 3 PMA systems. On the right in blue, the first column labeled PMA low is a system I built for the objective of conservative growth with lower drawdowns, with the goal of outperforming the 60-40 buy and hold approach. The third column labeled PMA high is a system I built for the objective of aggressive growth where higher drawdowns are okay. And the column labeled PMA medium I built for the objective with medium growth, medium drawdowns.
Let me also just interject quickly here that so this one starts back in 2007, which was important because we wanted to make sure that we were capturing multiple moments when the market had extraordinary drawdowns. So that's including the 2008 long-term capital management meltdown and the housing market meltdown and the COVID meltdown. Right. So you're getting 3 absolutely emotionally damaging market collapses as well as moments of growth. So this one, these systems have survived 3 existential threats to the psychology of the trader, if I can say it that way. Yes. The greatest pain of market meltdowns is not the temporary loss of 50 to 70% of your capital, although that is painful. The greater pain is to use that as a reason to not get back into the market and then watch it move subsequently to higher highs. And then you not only get to suffer all the way down, but then you avoid the recovery period, and that hurts even more and just solidifies a person's belief that markets are rigged against them and they can't do anything about it. That combination, the double whammy of bear markets, is overlooked in the literature. It's the pain of loss, but it's even greater the pain of missed recovery. Now, if you're an old fat guy like me, sometimes you're not going to be around long enough to get it back, and so you got to be concerned about preserving what you have. But for longer-term market participants, the experience of catastrophic loss either gets them out of the game or it chases them away from the game forever and ever. So it's important to note that these systems not only endured the losses, but also participated in the recovery moves and then stayed with it once markets got better. So go ahead, Bill. I wanted to make that point. Carry on.
Yeah, Ken, it's a fantastic point. I use these systems for my wife's retirement account, for my son's college education account, and have traded these through some really nasty moments in stock market history, including the COVID crash. And the psychological, the emotional, and the financial impact of getting out of the way of those major bears and then getting back in to compound the gains that we preserved once the market starts to head back up again. It's just enormous. I just can't convey really very well in words the huge difference that makes. And to your point, when we look at the stats here, so we look at PMA medium and PMA high, and I said that I designed those with the objective of more aggressive growth where higher drawdowns are okay. But when we look at the drawdown stats here, we see that actually the drawdowns are less than that of the S&P and also less than that of 60-40 buy and hold. So for example, if we look at PMA medium, we have a drawdown that's less than 60-40. So that's, your average retail investing public with a return that's higher than the S&P 500. And same thing when we look at PMA high. So it's really phenomenal, the power of some very simple concepts like moving averages, like momentum.
Yeah, it's not ironic, or maybe it is, that 2022 and 2023 is the worst performing years of the 60-40 old reliable system in the last 40 years. And so at the very time you need it the most to protect against volatility in a world at war is the time when the 60-40 conservative wisdom fails. Which is, sad but true, that the fat tail event is what you're trying to protect against with that kind of diversification, and yet when it occurs, that's when it fails. That's like having a business plan that works all the time except for when you need it the most in a time of crisis. Well, that ain't any good. That's like an insurance policy, against a flood that has a little footnote on it that says, offer not valid during times of flood. Well, that's not much flood insurance. So I guess that's an important point. The other thing, just as a rule of thumb for the folks out there, when you're taking a look at these systems, just a handy way to understand those large numbers is the rule of 72. When you take a look at the compounded annual growth rate, divide that number into 72, and that tells you how many years it takes at that rate to double your money. So if you went to the first column and it was 9.5, that goes into 72 7 times. So then if I started with $1 and doubled it 7 times, at the end of 16 years, I should have 1, 2, 4, 8, 16, 32, around 7. So that's about right. And the same thing on the 16, it's doubling every 4.5 or 5 years. That starts becoming significant because you end up getting a growth rate doesn't come all at once. This is the slow incremental move. So there's some good books out there now that are talking about disasters occur frequently, but the good news takes time and slow growth to compound and to benefit. So you don't get, again, it's the good news is not symmetrical with the bad news. And the lessons that people should have learned from market collapses was that's where the opportunity to plant the new forest after the fire has burned everything down, that you got to be thinking about the next cycle and not being an emotional shock that the markets melt down. That's not surprising that markets melt down. That's the expectation that should be with you all the time. Manage against the risk, and then when the risk event occurs, be ready to take remedial action and recovery action and the rebuilding action. That's what we got to be able to have in our mind. So when times are great, you can't be optimistic, enthusiastic. You got to sort of be an old grudge, a curmudgeon. And when times are bad, you can't be in panic and despair. So you always got to take the sort of the balancing emotional stance in order to stay true to applying the rules that are appropriate. So that's what I wanted to say about this this section. Go ahead.
Yeah, and Ken, to your point, in researching, especially these PMA-based monthly asset allocation systems, when you look into the details of the performance, one of the keys or the secrets, if you will, to the long-term outperformance is that they avoid those major bear markets. And so you preserve all the gains that you've made in those upward grinding slow years. And then you've got all that capital to put to work when the market turns around. And so those gains just keep compounding over time. So to your point, yeah, that's exactly what's going on with these systems.
Yeah. Yeah, something I would add in here too is that when you're working with the moving averages, so people that hate them or talk smack about them always say, well, it's a lagging indicator, and so it's like trying to drive a car by looking through the rearview mirror. Yeah, but no. What it does is reflects sort of a consensus of the herd mentality. And so combinations of moving averages now start making sense, where you want the slow one to reflect the conservative portion of the the fifth mouse and the fourth mouse. And then you want something on the front end that's showing how quickly the leading edge can change. And then when the fast crosses over the slow, you're in kind of the no man's land of a transition state, that the long-term guys haven't felt the fear yet, but the leading guys have already started posturing for the downside. Now, which one is right? We know that most of the time the longer-term trend is going to be good. That's the basis in momentum for all long-term trend-following systems. But those typically have to endure larger drawdowns and take long periods of time for that advantage to unfold. So by doing the low, medium, and high, what you're doing there is adjusting fast-moving averages in order to get some contingency rules to allow us to participate in those volatile transformative states, the sideways markets. A lot of folks have spent a lot of time and money trying to optimize the style or the type of moving averages. The best thing to do is to just get your favorite symbol and then sling all of them on there, all looking at the same look-back period, and then see the actual difference between triangular moving averages, weighted moving averages, exponential, double exponential, the Jurek moving averages, which are based in, signal processing. The biggest improvement that I've seen over traditional moving averages is that regression line moving average, the least squares moving average, because it's about 3 times more. You'll see that the least squares moving average, which is another way to say the regression line moving average, is much more adaptive than all of those other ones except possibly the juric, but you got to pay money for the juric. I use the moving averages in two different ways. One of them is to use my own versions to help me make my decisions. But the second way is I like looking at the simple moving averages, 10, 20, 50, 100, 200, in order to understand how the herd feels at any given time, to decide, hey, are we running out of the milk of human kindness? Are they starting to get spooked? Are they? If there are millions of people looking at the crossover of the 50 and the 200, and half of them are going to make a decision, then that has a power all of its own. Is the decision, is that a good indicator because it works, or does it work because people believe in it? That's sort of. Do people believe in it because it works? Does it work because people believe in it? It's both of those. It is a convergence of belief and evidence, in essence. So I always, when I'm looking at indicators that are popularly available, I always have them set to the default positions, because that's where most people are going to have them, and I understand what the common interpretation of them is. But then I use that information to help me tune my decision making. If we go back to the PSAR, nobody's using the PSAR as a way to trigger the reversals or to look at the size of the box to gear your position size, and they're not counting the dots, and they're not using regression lines as the data source. They're trying to capture the volatility of the bar inside the PSAR dot. Whereas I believe you should be using the Bollinger Bands or your risk box and go for a smooth PSAR. So when you start looking at all three of these features, these actually share a common point of view about what the data is, where it comes from, and how to interpret it. And you'll actually see that Bill's using all three of these ideas in the construction of robust systems. So these are not three separate ideas at the end of the day. These are actually mutually reinforcing ideas, that the PSAR plus momentum plus moving averages for filters all are informing the system design, and that's what makes these things robust. So those were the comments that I wanted to make about the moving averages. I think it's important to understand why they work, how people look at them, and I might also say that I even use the moving averages inside other indicators, like when we look at the MACD histogram and the 4 seasons. I use a moving average on the MACD signal line to determine how far has that reversed before it becomes significant. I put Bollinger Bands on indicators for exactly the same reason, to start understanding how the interpretation of the indicator could be understood from data. So I want to make that point too. So let's open it up to any other questions, broad in nature, or on anything that we've covered for the people. And while we're waiting for those maybe to come in, Bill, any concluding remarks or maybe some comments about where you're looking for future excursions?
Yeah, so I would just say to everybody here that keep it simple. That I am a student just like all of you guys. Like I said, Ken is an endless stream of genius ideas. Keep it simple. Start with the ones that resonate with you, that fit with you, that you understand. And there's really no secret to developing systems other than just shoveling coal, which Ken talks about all the time. It's just work. The coal doesn't shovel itself. I would say get an accountability partner and be consistent and regular with your work. And it's doable. It's all doable.
Yeah, I think the biggest advantage of the accountability partner is that it lets you bring to the surface your own insecurities. And then once you look at them in the light of the day, you just realize, oh, that's just a consideration, and I can account for the fear. So I can take the sting out of the fear. When you have that inside you, it hurts. It hurts your internal organs. When you bring that out into the light of the day, you actually get someone who's not feeling the fear, who can help you understand ways to mitigate it or protect against it. So you're getting the advantage of their rational mind with your own fears. And then when it comes to research, it allows you to offset the risk of your hidden assumptions or your biases, because they're looking at it fresh, and it's easier for them to ask the questions that expose maybe some of the shortfalls or the limits of our beliefs. So the accountability partner in sharing the research is great. It's also great when it comes to developing trader expertise, in that you give your rule set to them to trade, and then you watch them try to trade it, and then that exposes areas where your rules are not complete because they're making assumptions. And you say, oh, no, that's not what I do. And then you use that to uncover your rules, hidden rules. Mark asks about the 2R battle drill and says, is that integrated into your systems? My spider sense is that it is not. Can you confirm that?
Correct. It's not integrated into these systems that we look at, that we're talking about here, but that said, the 2R battle drill is freaking brilliant.
Yeah.
And I do apply it and components of it in other systems that I trade.
What I would say on that one is exactly what you said, and that is the 2R battle drill is a rules-based insight that tells you when you should consider turbocharging your result. So if you look at the high-performance racers, they use nitroglycerin or nitric oxide in their fuels for the burst, and that comes with a certain amount of danger. So the 2R battle drill is a power tool that's going to make you more of what you are. If you are an undisciplined person and you try to use the discipline of a 2R battle drill, you're going to go bust sooner. But if you're a disciplined person and you apply the 2R battle drill with discipline, then you can actually use that as an opportunity to make more money. So I think of it as in this way, that the initial stop that you set and the initial adjustments on your trailing stop or whatever you're using is designed to help you with the trade-off of how to let that thing grow in order to find the ones that are really going to be good. Think about a person who has a greenhouse. What you really want is the strongest. You want to plant 1,000 seeds, and then you want to take the 200 that are growing the best and the fastest and move them to the next stage greenhouse where only the most brilliant things are really growing the fastest, because they're going to give you the most return. You also want to use those to help you develop the next generation of seeds that are built on tremendous growth, right? So the 2R battle drill is how I decide which ones to really concentrate on with the turbo. So if I'm using the 2R battle drill on the 30-minute bar, when they get 2R on the 30-minute, that's a signal that I should be using the 3-minute bar to optimize it even more. Conversely, if I plant 1,000 3-minute bars, the ones that end up becoming the best are ones that I can shift to a 30-minute bar and let them grow forever because they survived the initial volatility. So the 2R battle drill should be looked at, in my view, in that lens, as a way to really turbocharge. You saw some evidence from just this week, from Friday, where Cliff, if you just took the first position and managed it correctly, you got something like 15R. If you use the 2R battle drill judiciously, it ended up being 30R. and never took higher risk than you took on the first position. So that's the discipline of the 2-hour battle drill. Not only to add positions systematically, but also to systematically manage the increased risk that comes from larger positions. The discipline is on both. It's not just when to add, it's also when to exit and to get all out. So that's what I would add to that. Okay, any other questions for Bill? And you can use your audio if that's easier than typing. We got about another maybe 10 minutes of Bill's time at the most. And then what I would also say is, as you reflect on this, as other ideas come to you, if you'll send them to me, I will collect those for a second round of follow-up questions. Yeah, we'll do one more of these that once we get, maybe by the 15th of December, if you can get me your questions by then we'll let Bill answer those in an efficient manner from one consolidated list. So, Bill, if you don't mind doing that, then we'll make that a part of the deal. Yeah.
Happy to.
Yeah, I would also just point out, Bill won't toot his own horn, but we've migrated the workshops that he was teaching from BTI to our OWL Group Rizuku platform and made them part of our course catalog. And those include the question and answer sessions with the students as they were taught back then. So just the standalone versions of those are worthwhile and amazing. And if there's enough interest, we might persuade Bill to do live office hours in the future. He's got a lot of other things going on, but we'll play that by ear. But just the home study course versions plus all the recorded Q&A sessions of those are amazing. And those are in the course catalog as well. So last round for questions here. I just want to say that working with Bill is an absolute joy. He and I did a drumming album together. And when I say together, this is what I mean. That he took some of my spoken word performances. When I get on a roll sometimes, it almost has a ritual chanting approach to it, which I attribute to working with him, that he helps me find my inner rhythm, and then that takes over, and I'm able to express ideas to my inner rhythm, and I just trust that. And then he cleans that up and puts original soundtracks of rhythm to it. So we have an album of 10 songs. 5 of them are pure drumming, and those are my favorites. And then the other 5 are drum backgrounds to the spoken word, and we have that on sale for a nominal fee there in the that helps support our leadership scholarship programs. But it was just a hoot to do this. Oh, here's one from Mark. More of a comment, really. The diversity of systems in the community shows the mindsets behind it, and the fact that there's a lot of different ways for us to make a living in our ecosystem. When we're going to listen to Sonal in the future and her journey to discover, is she a hunter or is she a farmer? And it turns out that she has both of those qualities, and she's learned to recognize that and reconcile them and let each part of her do its own thing. So she lets the farmer farm. And when the crops are growing, she wants to let them grow, which is now a good time to go hunting. And it's good to be a hunter with the peace of mind knowing that the crops are at home being cared for and that there's food on the table when I leave here, so I reduce some of the stress of hunting. So the mindset of a year-round, multi-season tribal community of practice is absolutely central to the long-term advantage that we have, which I believe is built on trust, transparency, true storytelling, mutual support, and positivity. I rely on Bill's eternal optimism to help get me through my dark times. I have dark phases when I'm just not a very pleasant person, and that's not good for me or those around me. And Bill's eternal optimism and the drumming techniques that he's taught me have really helped me moderate my evil nature and turn it into positive energy. So here's one I want you thinking about, Bill, and that was what to do with evil intentions. What you have helped me do is the following thing, that when I feel evil intentions or fears coming in, I immediately go to a safe space and I exaggerate the feeling and I take it to its logical extreme and just feel all of it at once and take all that energy and put it in a container and launch that container into deep space. Done. Now I can take that ripped out empty darkness, that space that used to have all that, and I fill it with good soil and good seeds, and I grow flowers and tend that, and now that evil space has been filled with goodness. And once that's done, I let that grow. Like, you can't make flowers grow faster by pulling on them. You got to let them grow according to their own nature. But then I go into deep space, and then I take that nuclear waste safely away from other people, and I turn that hateful energy into batteries and storage and safely bring that back to Earth and use that to power the power tools in the darkness. But I do that processing of the evil intent in a safe space where if I get burned, it's just me getting burned. It doesn't burn other people. And if it explodes, it doesn't harm anybody else or the environment around me. Well, that little cycle is sort of now a moving picture, almost cartoonish, that has soundtracks associated with it. And so when I'm going through that rhythm, in the sauna or in the safe space where people will not be offended by my poor drumming ability, I can go through all those and turn the energy into some kind of rhythm, which is the positivity that turns it into energy for my battery. So for me, the drumming incorporates all three methods of learning or modes of learning. There's the physical feel of your hands hitting the drum. There is the sound of the drum, but there's also the sound of your hands leaving the drum. That makes a noise. And the sound of your breathing. So you're hearing, and then you can also see your hands hitting the drum, and you can see the shape of the drum. So it's not just seeing, and it's not just hearing, and it's not just feeling. It turns out to be the integration of all three of those. And if I can say what the biggest lesson that I've ever learned from you was the simple insight that you cannot play the drum wrong. The drum can only be played, and whatever sound you made was the sound you played, and it was correct and true in that moment and complete. It was a complete statement of a beat, and that beat by itself cannot be wrong. It can only be true. It is exactly what it is. And once you learn to accept that, you just say, that was okay. That did no harm. That was a true statement of where I was. And then all of your fears and worries go away, and you become centered in the moment of the beat, and then the diminishing sound as it reverberates to the universe, and then the next one tells you, when you feel like, when is the next time I should play a beat? And whatever that is, you're right. That's when you should play it, is when you did play it. And then you just learn to trust that, and you just calm down. So I really found that to be helpful as a metaphor, and as a thing of itself. I mean, for 40 years I wanted to drum, but was always afraid of what it might sound like. And so you taught me that just play the drum. Just stop thinking so much. Just play the drum. So I want to thank you in public for that.
You're very welcome, Ken.
Moment of Zen.
I'm glad to know that I've
Yeah.
been a contribution to you, because you've certainly been a huge blessing to me and my family. And I think I can speak on behalf of all of us here in the tortoise community about what a gift that you are. So I'm thankful and honored that I've been able to give something back.
Well, I want you to go play some soccer and coach some soccer. That's really where you find out how to apply it. And I enjoy watching you learn how to coach soccer, because, you know, I've learned to drum from you. Now maybe you get to learn a little bit about, you know, coaching youth soccer and all the joys. And just remember that the best part of coaching youth soccer is the parents, because they are 100% helpful in what they yell from the sideline. You know, the helpful, positive energy that they bring. You know, the way they praise the referees and they praise the other teams, and they're never hurtful in their comments. That's the best. That's the most refreshing part of youth soccer to me, is all that parental energy. So enjoy that for the gift that it is. Anyway, say hi to the family for me. Much love, and we'll be with you on the field in spirit. So thanks so much, guys. Then thanks a lot, Bill. Our next scheduled session is at noon today, noon Central Time today. Jeff Southern's going to come in, and we're going to get going. So I will get this published and processed. I'm going to hang it as a downloadable file inside of your lesson. I inadvertently put 2 copies of that in 2 different lessons, so that's going to be just one lesson under Bill's name, and the recording session of it will be a downloadable file inside of that lesson. And when we get, you know, future questions or whatever, we're going to put an FAQ in there as a way to answer the questions in a growing fashion. So that lesson could very well end up being a course in the future. Think of it as a growing course. I will collect the questions, post them in there as a downloadable file. The answers that Bill gives will be part of that FAQ. And so that's going to be a repository inside research now and forever, you know, amen. 2024, we'll do the same thing with a new set of folks, but for the year ahead, your lesson will expand, much like that little tree that's growing inside the greenhouse. That lesson inside Rizuka will be where all of the material for this will continue to grow. So any last comments, Bill? And otherwise, we'll hit the tones and declare job well done as always.
Mission accomplished. All
right, fellas. 3, 2, 1, and we're done. We will see you in about 90 minutes for Jeff Southern. Equally amazing in a completely different way, but that's sort of what you would expect. It's a remarkable presentation coming up. So thanks so much, Bill. Everybody take good care, and I'm going to go eat some breakfast. Cheers.
Thanks, Ken. Cheers.